Hello and welcome to my short video recording series. The topic that we will be covering today is measures of leverage. This is a short topic in corporate finance. Before we get started, let's just talk about some basics of cost accounting. So we know that the total cost is made up of two types of costs. You have total variable costs. In short, you may call it TVC, plus you have total fixed cost. Now, what is total variable cost? This is the cost that tends to change with the level of activity, with the level of production. So as you produce more, as you produce and sell more, this cost would actually increase. The example of that would be, let's say, cost of raw material. If I'm selling more, I need to buy more raw material. I need to employ more direct production labor as I actually produce and sell more. So here is how we could actually depict this. Let's say we have the quantity produced on x-axis, and on y-axis we have total variable cost. If we are producing 0, then the variable cost would actually be 0. But as we produce more, our cost would actually go up. So if we produce 1 unit, this would be our cost. If we produce 2 units, this would be our cost, and so on. So notice, as the level of production goes higher, the total variable cost also actually goes up. Now, if you think in terms of risk, if you're producing more, you have a higher cost. If you're producing less, you have a lower cost. So if in a period in which you sell less and hence you produce less, your total variable cost would actually be lower because you'll buy less of raw material, you employ less of the direct labor, and so on. Hence, variable cost does not pose much risk to the entity, because if it is selling less, it will have less variable cost as well. On the other hand, fixed cost poses the risk to the organization, and the fixed cost would look something like this. You have a total fixed cost on y-axis and the level of output or quantity produced on x-axis. Notice, no matter what you produce, whether you produce less or you produce more, the total fixed cost remains fixed. The example of fixed costs could actually be admin salaries, finance, etc., accounting department, all those basically where you have fixed cost that you're actually paying. It could be the fixed rent of a factory, it could be the fixed rent of a building, etc. So all those are called fixed cost. Now, how come they pose a risk? If you're selling less, if your sales are falling down, you still have to pay the same amount of fixed cost. And the higher the fixed cost, the more losses you're most likely to face, because when sales drop, your profitability will actually decline by a significant amount due to the level of the fixed cost. So what the firms need to worry about is basically the fixed cost. It is the fixed cost that affects the profitability, or in short, we could say that the profit is actually sensitive to the level of fixed cost. High fixed costs would actually make the profit far more sensitive, while variable cost as such will not have much effect. In short, your production related costs, generally speaking, would actually be variable, not all of it, but for the sake of our understanding here, let's suppose that all production related costs would actually be variable. Hence, the cost of goods sold, which is the cost of producing the item or the cost of manufacturing the item, we would assume it is variable. Of course, not all the components of it are variable, but we'll just make that assumption that all of this is actually variable, while all other costs, all other operating costs, such as sales, general, admin, would be assumed to be actually fixed. Now, when we speak about fixed costs, in short, let's call it at C, fixed costs has got two components. Number one, we could say fixed operating costs. So costs related to your operations, as we said, such as admin, accounts, finance, sales, etc. All these are basically your fixed operating costs. While the second type of fixed cost is fixed finance cost. In short, you may call this interest. The fixed finance cost is actually your interest. All right, so when you borrow money, you have to pay a fixed amount of interest, not always, but let's assume that you're paying your fixed interest. So that also actually poses the risk to your profitability. So the risk to your profits arises because of having high fixed costs, and fixed costs have two components. In short, you have fixed operating costs and you have fixed finance cost. All right, before we start looking at the risk measures, we will just discuss components of risks. So when we speak about risk can be broken down into, number one, business risk. And what is business risk? This is the risk associated with the kind of business environment and the industry that the firm actually operates in. And one kind of business risk, one component of business risk is what we call sales risk, which is the fluctuation that arises in your sales. And if you recall from financial reporting subject, sales is composed of price times quantity. That is the volume. So price times quantity actually gives you sales. So fluctuation due to change in price or due to change in quantity will cause sales to fluctuate, and that is what is defined as sales risk. So if for any reason, let's suppose due to high level of competition, due to high threats of new entrants, or threat of substitutes, etc., the price for some reason goes down, or the quantity that the company actually sells, the volume that it sells goes down, this will cause the sales of the organization overall to actually decrease, and that is referred to as the sales risk. The second type of business risk, or the second component of business risk, is what we call operating leverage. Which is the risk that arises due to fixed operating cost, and that's exactly what we said earlier here. And so it's basically the risk that arises due to fixed operating costs. And a measure of this risk, a measure of this particular risk is called degree of operating leverage. In short, we will call it DOL. The second type of risk that you have is financial leverage. And financial leverage, or leverage, is actually, financial leverage is measured by the ratio, like solvency ratios such as debt to equity. And we know if a firm has high level of debt, that means it will have to incur high fixed interest cost. And that is what would actually pose risk to the profitability. Hence, financial leverage, the risk that arises due to having high financial leverage is basically the fixed finance cost, which is your interest. So we have two types of fixed costs: fixed operating cost, and a measure of that risk is called degree of operating leverage, while a measure of financial leverage, or risk for financial leverage, is called degree of financial leverage, which is DFL. All right, so this is how you need to remember the decomposition of the risks. Business risk is made up of sales and operating risks, or operating leverage, and the other type of risk that we have is actually financial leverage. Now we are going to discuss how to calculate these, and that is what you need to focus on. So we'll now look at the calculation and interpretation of the two types of risk, that is degree of operating leverage and degree of financial leverage. If you notice in this picture, nowhere you see variable cost being defined as risk, because we said that variable costs do not pose risk. If you're selling less and producing less, then your costs would be lower. If you're producing and selling more, your cost would only then be higher. Hence, sales going down would be a risk, but having fixed operating costs and fixed finance costs would also be the risk, but not variable cost. All right, so how do we actually calculate the degree of operating leverage and the degree of financial leverage? I'm just going to write a pro forma here, and then we'll see how to do the calculation and how to do the interpretation. Let's say, as a first thing, we have got sales. You may call it sales, you may call it revenue. So let's suppose we have sales, and then we subtract the variable costs. And when we subtract variable cost, we get, let me call this contribution. You can give it any name, but the reason why I'm calling it a contribution, this is a profit that would allow us, or that contributes towards the coverage of our fixed operating cost and fixed finance cost, that is interest. So this is your profit after variable cost. Let's call it contribution. Then we subtract fixed operating costs. In short, let's call them fixed FOC, fixed operating costs. When we subtract those, we get operating profit. You may call it operating profit, you may call it operating earnings. It may also be called as EBIT, earnings before interest and tax. And then you subtract your interest, which is your fixed finance cost. So let's call it interest, and that's what we are subtracting. And assuming that there is no tax, if there is tax, of course, you'd have to subtract that. If I assume that there is no tax, then you get your net earnings, or you may just simply call it earnings or net income. This is a very simple pro forma. As long as you remember this, hopefully it's going to become a lot easier to come up with the formula for degree of operating leverage and financial leverage. All right, so as we said before, if for any reason your sales are declining, and that is referred to as sales risk, which could decline due to price or volume decline, then your variable cost also declines. Hence, your variable cost does not pose a risk that will cause your contribution to decline. And when contribution, just profit after variable cost, declines, your fixed costs remain the same. That will cause your operating profit to maybe decline by a much bigger amount than the decline in the contribution. And that is what poses the risk, which is called degree of operating leverage. Now, how do we calculate degree of operating leverage? Here is how you could actually understand this. If you look at the profit before the fixed operating cost, that is called contribution. If you look at the profit after fixed operating cost, that is called operating profit or EBIT. So if you want to measure the impact of fixed operating costs on the profit, all you have to do is just simply look at the profit before the fixed operating cost and look at the profit after the fixed operating cost. And that's exactly what we use to calculate the degree of operating leverage. So here's how we do it. We say degree of operating leverage is, all we need are these two things, which is the profit before and the profit after. We say is simply contribution divided by operating profit, which you may call as EBIT, which is the profit before divided by the profit after. Notice, if your fixed operating costs are high, your operating profit would actually be low, which means if your EBIT is low, then your degree of operating leverage would actually be high, which means high amount of the high degree of operating leverage represents higher risk. Similarly, if you want to measure degree of financial leverage, so where does the finance cost come into this picture? It comes right here as interest. All we need to do is, again, look at the profit before interest and look at the profit after interest, which is operating profit and earnings, in order for us to study the impact of fixed finance cost, that is interest. So all we will do is we'll take the operating profit, which is our EBIT, and divide it by the profit after interest and taxes, which is simply our earnings. Again, if your interest cost is high, your earnings would actually be lower. Lower earnings would imply higher financial leverage, and high financial degree of financial leverage would mean higher risk. All right, let's say for the sake of our understanding, let's say this is 2 and say this is 3. So the degree of financial leverage is 3, while the degree of operating leverage is actually 2. So operating leverage measures the impact of fixed operating costs. Financial leverage measures the impact of fixed finance costs. How about if we want to combine the two and look at the impact of the total fixed cost, which is fixed operating cost plus fixed finance cost? And that is referred to as degree of total leverage, which is fixed finance cost and fixed operating cost. Well, if you look at total leverage, we look at the profit before the total fixed cost. The profit before the fixed cost is called contribution, and the profit after the total fixed cost is called net earnings, right? This is what we did for financial leverage, which was EBIT over earnings. So all we need to do is look at the profit before the fixed operating costs or fixed cost and look at the profit after all the fixed costs. So all we would do is we'll take the contribution as we did before and divide it by the net earnings. And this captures the impact of the total leverage, that is the total fixed costs, total operating costs and total finance cost. Alternatively, which is going to be, we could also look at degree of total leverage as a combination of operating and financial leverage. So you might be thinking that all we will do is we'll just simply add these two up. But that's not what we do, because we cannot use addition rule since we are dealing with risk here. We would be using multiplication rule to come up with our total leverage. That is, all you're going to do is 2 times 3, which is 6%. That's your degree of total leverage. Well, so far we have discussed the calculation part of it. That's what we have been covering so far. So onto the left side, I have shown to you how to do the calculation. On the right side, I'm going to focus more on the interpretation of the numbers that we actually got. So let's focus now more on the interpretation. How do we interpret the numbers? We know that high DOL, high DFL, and high DTL means higher risk. But if we say that DOL is 2, what does that actually mean? Well, notice, as I said before, if your sales go down, say by 1%, your variable cost will also go down. That will cause your contribution to go down. But because of fixed costs not changing, your operating profit will go down a lot more. And that's exactly what you see. If your sales, let's suppose, are going down by 1% and you have a DOL operating leverage of 2, that means your operating profit will go down by 2%. So your operating profit is twice sensitive to change in sales. And what is the cause of that? The cause of that is because the operating costs, fixed operating costs, are actually fixed. I'll repeat again, what does 2 mean here? If your sales drop down by 1%, your profit will drop down by 2%. That means your profit is twice sensitive. The profit will be affected twice the size of the change in the sales. So here is how we interpret. For our interpretation, we start from sales and we stop at the operating profit. That's what we do for interpretation. So we said degree of operating leverage can, if the answer was 2%, how do we interpret this? We interpret this as percentage change in operating profit, which is EBIT, divided by percentage change in sales. That's the interpretation. So what we are saying is, if sales change by 1%, your operating profit is twice sensitive. That means it changes by 2% for each 1% change in sales. So if sales go up, operating profit will go up by 2%. If sales go down by 1%, operating profit will go up by 2%. So if sales go down by 1%, operating profit will go down by 2%. All right, let's talk about degree of financial leverage. So how do you interpret that? Well, the way we interpret is when your operating profit goes down, interest is a fixed cost that will make our net earnings a lot more sensitive because of the fixed interest cost. So if we assume that our operating profit is going down by 1% and we have a DFL of 3, that means our earnings will actually go down by 3%. So earnings is 3 times more sensitive to changes in the operating profit. And that's exactly the interpretation. We are saying percentage change in net earnings to percentage change in operating profit. So if the answer is 3%, that means for each 1% change in operating profit, your net earnings will actually change by 3%. When we speak about the degree of total leverage, which was 6%, how do we interpret our total leverage? Well, we start right from the top and end at the bottom because we're trying to assess the impact of total fixed cost, which is fixed operating cost and fixed finance cost. For a degree of total leverage, if sales drop down by, let's say, 1%, that means your net earnings will drop down by 6% because of fixed operating cost and fixed finance cost. So here's the interpretation: percentage change in your net earnings caused by percentage change in sales. So if your sales changes, and the answer is 6%, that means for each 1% change in sales, your net earnings will change by 6%, meaning your net earnings are sensitive to sales by 6 times, right? That's what it actually means. So you have to focus a lot on interpretation. While you should know the calculation, yes, it's important. It's extremely important to focus on the interpretation of this as well. Now, sometimes they ask you questions like, of course, they could give you a question on where you have to plug in all the numbers and then use these formulas to get the answers. Sometimes the focus could be like, they could tell you degree of operating leverage is 2. And if sales changes by 5%, what is the impact on operating profit? So we're saying if sales are changing by 5%, and we want to find the impact on operating profit given a degree of operating leverage of 2. And to answer this, it's quite simple. If you know the interpretation is percentage change in operating profit, or change in operating profit divided by percentage change in sales. Well, we know that degree of operating leverage is 2 to 1, and we have been told that the sales changes by 5%. That means sales changes by 5%. Of course, if sales are changing by 5%, that means operating profit will change actually twice, which is it will change by 10%. So that would actually be the answer. So if they ask you about if they ask you about a question like this, this is how you would answer. Likewise, if we are told that sales changes by 5%, what is the impact on earnings given a DTL of 6%? We would actually say it will be 30%, which is 5 times 6%. That is 30% change in the net earnings. All right, we'll now look at a simple example for calculation. Let's say that sales are 1 million, variable cost is 200,000, which means the contribution, you may even call it gross profit, it doesn't matter what name you want to give it, it won't make any difference. Contribution is 800,000. Let's say the fixed operating costs are say 300,000, and that gives us operating profit, or profit before interest and tax, our operating profit of 500,000. And then we subtract fixed finance cost, which is interest, assuming there is no taxes. And let's say interest is 100,000. This gives us the net earnings of 400,000. That's our net earnings basically that we actually get. So with all this information that has actually been given to us, we'll now try and calculate the degree of operating leverage and degree of financial leverage. We know degree of operating leverage for calculation was the profit before operating costs and the profit after. So all we would do is contribution divided by operating profit. And contribution in this case is 800,000, while operating profit is actually 500,000. So divide this by 500,000. Let me get you the answer. The answer is 1.6. That's our degree of operating leverage. As for degree of financial leverage, again, we look at the profit before the fixed finance cost and the profit after, which is simply operating profit divided by the net earnings, which is the profit after. which is 500,000 divided by 400,000. So, and that gives us degree of financial leverage as 1.25. If we want to find the total leverage, we can do it in two ways. We can look at the profit before the total fixed cost and the profit after, which is earnings. That's how we look at the total right here, both of these two. We would say 800K divided by 400K, and that gives us 2. Or alternatively, you could just multiply DOL with DFL, which is going to be 1.6 times 1.25, and the answer you should get is basically 2. How do we interpret the DOL of 1.6? That means for each 1% change in sales, let's say if sales go down by 1%, then your operating profit will actually go down by a bigger amount, that is 1.6%. And that's the interpretation of DOL, which is the sensitivity of the operating profit to changes in sales. It's 1.6 times sensitive. As for the financial leverage, that sensitivity of your net earnings to changes in operating profit. So if your operating profit goes down by 1%, this would actually go down by 1.25%. If we combine the two and we measure degree of total leverage, which is 2%, so the interpretation would be, degree of total leverage would be, if this goes down by 1%, then net earnings would go down by 2%, because it's twice, net earnings are twice more sensitive to changes in sales.